Howdy, Jacob here. Today we're looking at the company Cummins in the machinery industry, just under 39 billion market cap, just under 42 billion enterprise value. So slight amount of net debt there, but not a substantial amount to be incredibly worried about. Founded in 1919, they manufacture, distribute, and service diesel and natural gas engines, electric and hybrid power, trains, and other products. Growth has been low to mid single digits over the last 10 years, year over year, with heavy growth the last 3 years. Their growth was essentially flat for 7 years, but it did decrease a bit from COVID. So, I mean, outside of COVID years, you're probably looking at pretty solid 5 to 7% year over year revenue growth. Not bad, but a gross margin of mid to low 20% and a sub 10% operating margin. Return on invested capital historically has been double digits, so that's a very positive sign. Balance sheet shows $2.7 billion in cash-like products, 1.9 billion in short-term debt, 4.8 billion in long-term debt. So they have enough cash to write off that short-term debt, which is positive. But that 4.8 billion, let's see what that is in relation to free cash flow. Cash flow seems to be above 2 billion, and so that is less than 3 years of their 5-year average free cash flow to pay off that debt. We're not concerned about it. It has gone up 3 times, 1.6 billion to 4.8 billion over the last 10 years, and their free cash flow has not grown as much, but still not terribly concerned about that. But we don't want them to issue too much more debt without really increasing that cash flow. So let's look at their use of cash, and we see they do pay a dividend, 2.6% yield. It pays almost $1 billion at this point, so the payout is probably around 40%. Bought back some shares quite a bit between 2018 and 2021, not as much recently. They go from paying debt to issuing debt. They've definitely issued more debt than paid debt, though. Acquisition, one big net acquisition, otherwise just some small ones, some reinvestments with a low double-digit return on invested capital. I do like to see those reinvestments. So I think we're ready to make some assumptions here. I think on the revenue growth side, I could probably see 6%. I think organically, they're probably growing close to inflation. I mean, they've been around for quite some time, 1919, over a century. But I do think that with a little bit of money to acquisitions, hopefully more to reinvestment, they're able to get 6% return. I think margins, I'm going to say they get back to that 9-10% range. Or 8-9% range. We'll see if they're able to do that, because right now the average has been 7.7% over the last 6 years. For share change, they have repurchased some shares recently, not as much though. We see that they have repurchased as much as $1.3 billion in a year. 1% for them would be about 387 million. Not a whole lot, if any, of stock-based compensation. So I think 1% seems pretty reasonable to me. That would be about less than 20% of their free cash flow going to share repurchases. Again, we know about 40% going to dividends, leaving about 40% to make acquisitions, pay down debt, reinvest back into yourselves. I think I'm pretty comfortable with that. So PE and price free cash flow, 6% growth rate, pretty solid. We'll see at the end of 7 years whether they can hold that or not. What have they done with, I guess, let me see what they've done with dividends in the past. They have increased them. So I think I'm comfortable increasing it with their revenue growth. But I will say that might dampen their revenue growth a tad, because they're paying more capital. They're allocating more of their capital, free cash flow, to, instead of reinvesting, going towards dividends. And again, that's just me balancing out what they've done with the past with what I want them to do. They've increased their dividend every year for the last 10 years, and a minimum year-over-year growth of 5.3%. So if I increase it 5%, that's going to limit their allocation of capital to reinvestment, acquisition, everything. So I think I'm fine with that, with a terminal PE of 15 market average. I think this is a pretty standard company. I do think they have a good return on invested capital, but I think at the end of 7 years, growth might be a little difficult. So I think, and they're not reinvesting everything, right? So if they have a high return on invested capital, but they're only allocating 30%, 20% of capital towards it, what kind of premium does that really deserve? Not as much in my perspective. I think if you are able to really reinvest and actually reinvest at double-digit rates of return, you absolutely deserve a premium. But here we're just not seeing that as much. So I'm saying with my assumptions, it needs to fall 30% before I will do, or about 30% before I do a deeper dive. But either way, I do hope you enjoy the video and have a great rest of your day. Thank you.